Past quarter has been a very strong returning environment driven by the equity rally and bonds doing very well and the cut in interest rates. So from the higher risk options, higher growth, MySuper, Aussie equities have a very strong quarter and investors will be very happy with that type of return. What we've seen in the past quarter is that central banks around the world have cut interest rates, particularly here in Australia. We've had 2 rate cuts to 1%. We've seen negative yielding government bond rates in Europe and Japan, in Switzerland, record low bond rates here in Australia, and that's provided fuel for equity markets, share markets to rise quite high and over the last quarter and the last year. We don't think that's sustainable, but what you are seeing is rising markets as record low rates have forced investors to go up the risk curve. Our retirement portfolios are managed roughly the same as our pre-retirement. Obviously we have different options from higher risk to lower risk, and depending on where you are in your retirement, we prefer our members to have a bit more cash, a bit less risk in their portfolios, but they're managed with the same philosophy and process. They're structured for diversification, they're structured to do well or better in falling markets, and they have a longer term mindset. So there's no difference, it's just we would prefer lower risk options for those, particularly in retirement, drawing down an income. The RBA cut twice, and as discussed earlier, we've seen markets go up. And so the question is, why has the Reserve Bank of Australia cut interest rates? I would say two things. One, the economy is sluggish and unemployment stuck above 5%. Two, there's no inflation. And three, it's cut rates hoping that there will be lower interest rates will spur investment and consumption and take a little bit of pressure. And also what we're seeing is house prices have now bottomed and look like they've, after falling for the last year to 18 months, we're now starting to see house prices sort of bottom and slowly starting to go up. So the whole rate cut is about making sure the economy can still keep growing. Personally, I think the government can also step in and run a fiscal stimulus, and certainly the tax cuts will also help the economy going forward. So while the economy is a bit sluggish, we do think all of these measures should help the economy avoid a recession over the next year. This is an excellent question. A lot of people talk about short-term performance chasing, what is 1 year and what is over a life cycle. The most important thing is, remember, when you retire, when you're entering the workforce, superannuation is there as an income in retirement. And as you are younger, it's about building a pot, so therefore you can draw that capital and income as you retire. So 1 year returns are basically noise, and it's really the long-term performance that counts. And in our example, if you look at MySuper since inception and our 5-year numbers, the MySuper option now has a 6-year track record. It's solidly top quartile, and we manage investments over a 5-7 year time frame. So we're looking for long-term investments that will deliver. So what we believe there is, over the short term, we think it's noisy, but over the long term, we think you can compound and add value. Yeah, our long-term investment philosophy is to have very well diversified portfolios, managed for the long term, and particularly with statewide size, seek to find niche investments where the bigger players can't get access to, like small cap, like areas in the alternative space, perhaps a little bit in venture capital. So we're looking to build long-term portfolios, very well diversified, not managing to short-term market movements, and thinking that over time, if we can get that structure right and hold our temperament, we'll do very well over, say, 5 to 7 years. So the new government that's been elected, the coalition, it's still early days. However, the most important thing that they managed to get through were the tax cuts, and the tax cuts, if you file your tax form, you'll get some sort of credit and you get some sort of cash back. And that will definitely help the economy, plus the lower rates. So since the election, we've had 2 rate cuts, plus the tax cuts, and I expect there'll be some more stimulus coming through, and that should help the economy over the next 12 to 18 months. The US-China, as we call it, the Trump trade wars, is never-ending headlines and it still hasn't sort of been finalised. I think we can believe that this will go on for a while. There won't be a quick settlement despite what markets think, and it has been dragging. It's certainly affected consumer sentiment. It has affected industries and how they invest in their supply chains. And this may drag on for a while, and I think it will continue to be a thorn in the side for markets despite the rising share markets the last year or so. We believe in 2019 and 20, the lower rates plus the tax cuts, I suspect some fiscal stimulus, hopefully around the world, central banks doing the same, should provide enough fuel to keep the economies globally and in Australia going. So we don't foresee a recession, famous last words. In terms of the markets, we are passionate about short-term market forecasting is a bit like astrology. No one really knows. There's some sort of shock, whether external or internal, that could move markets. And we saw that in September, October last year. Then we saw the big markets rally the first half of this year. So we don't really into short-term forecasting, but we do think the economies will do fine. Over the longer term, the lower rates does provide a backdrop where equities and bonds can probably continue to do well because rates are so low. But we don't want to be totally dominated by equity exposure, which is why we're diversifying the portfolio across a lot of other asset classes and not just shares.
The advice in this video is general advice only. It may not be appropriate for you, and we recommend you obtain independent financial advice and consider the applicable PDS before making an investment decision.